Hi. So we are doing financial statement analysis. Many people call it FRA, financial reporting and analysis. That was the older name, FRA, that's what they call. The current name is FSA, financial statement analysis. It's around 11 to 14%. It has got a sizable weightage and it has 12 readings. Okay. Some of the readings are brief, like the first one and the last couple of readings, but otherwise, this is a very lengthy topic. In fact, out of all the topics, fixed income and FSA takes the maximum time. So this topic after QM, FSA and fixed income take the maximum time. In your exam, it's around 11 to 14%. I hope you all remember that 90 plus 90, there are 180 questions in your exam. Out of that, 11 to 14% is the range. So on an average, you'll get around 20 to 25 questions in exam. So be ready to get around 25, 2 dozens of questions. Okay. Now, because there are plenty of questions, right? It's a good opportunity because I'm sure everyone knows that you have to score minimum 70 percentage or percentile to be in a safer side. So to be on the safer side, you need 70 percentile. So that's where, if you take that into consideration, you, out of those 24 questions, if you think you at least need 18 to 20 right answers. So you can do 4 or 5 mistakes, that's okay. Now, we will start in the same flow as what you see in the reading here, right? Correct. The first reading is going to be the introduction of what is FSA, what is finance. Now, many students are worried about this topic because they think it is accounting. It is not accounting. But remember, whether you are running your own company or anyone's company, you will go back and check your bank account, right? You will go back and check how's the profitability, isn't it? Whatever business you do. So, what are the essential things to analyze the business? You don't need accounting, but you need to know how two companies' financial performance can be compared. For that, whatever basic knowledge you need about the financial statements, that is what your topic is all about. So, unlike many students wondering, those who are from non-finance background, they think, oh, FSA is going to be all about accounts. No, it's not accounts, it's finance. And trust me, most of my students who are engineers, they never face an issue with this. When we finish this topic, you'll realize that. Okay. So the next 4 readings, second, third, fourth, and fifth, these 4 readings, guys, they are your foundation of financial statements, income statement, balance sheet, and cash flows. After that, we are going to talk individually about the topics of inventory management, long-term assets, long-term liabilities, income taxes. These 4 topics are the ones where maximum questions in your exam will be asked from. But how well you do in these 4 topics is dependent on how well you've studied the previous 4 topics. So your foundation is built in the first 4 or 5 topics. This is where your foundation is built up. And then only you can do inventory, long-term assets, long-term liabilities, and equities and taxes. So students think they have a problem with these 4 topics, but the problem is not here. It's actually in these topics. So the more accurately you do balance sheet, income statement, and cash flow, the better it will be. Actually, finance students or non-finance students, for both of them, the situation is going to be the same. There's no difference here because it's completely fresh learning. It's a different aspect of learning financial statements. In the end, we are going to discuss about the reporting quality. This is what the analyst job is, to analyze the company's financial statement, whether the reports presented, are they accurate or not. This is what you're going to test and how to analyze that. So some of the techniques like ratio analysis and all, those are the things that you will learn in the later topics. And finally, you will see how everything can be put up into the model so that we can create a forecasted model. Okay. So for all of that, we will study the last 3 topics. So the last 3 topics are more or less a summary. Your focus will be on the 8 topics in the middle. This is where your focus will be. And exam point of view also, majority of the questions will be from the 8 topics in the middle. All right, everyone. So let's start with the introduction to FSA. Each and every topic is crucial. Now, many students say, sir, there are 12 topics, there are 24 questions, 12 readings, 24 questions. So on an average, can I assume 2 questions each topic? Yes, you can assume it, but don't be dependent on that. Sometimes topics like Inventory might have more questions. Long-term assets might have more questions. First topic, which is just an introduction, might just have one question. So it's not normally distributed, I can say. It's skewed. It can be random. So don't do over analysis. Just remember, overall, you'll have 20-24 questions, and there is nothing that you need that you can skip from the syllabus. What is core and essential thing is what I have put up in my notes. I'll also give you a review about the Schwezer book or the CFA Institute book with regards to FSA. In FSA, unfortunately, the Schwezer and the CFA Institute book is not in the flow. So what happens is that sometimes you learn some things in income statement, like what is capitalizing and expensing, but it is better learned when you reach balance sheet or when you reach long-term assets. Goodwill related adjustment, you'll see scattered here and there. So what I've done is that I've arranged my flow so that you learn step by step. So I would suggest you, if you are reading FSA, read from our books only. Then for extra knowledge, you can go to CFA Institute and all that. All right, correct? Fine. So let's start with the first topic, introduction to FSA, financial statement analysis. Now, guys, two things. First of all, what is analysis and what is reporting? Two different things. Reporting means whose job is to report the company's financial statements. By the way, what are financial statements, guys? We just discussed. What are the financial statements, guys? Financial statements, see, check on the next page. Your balance sheet, income statement, cash flow, these are the core financial statements. Okay. There are other statements also. We will discuss these other statements in a moment. But the most important, everyone is aware, balance sheet, which gives me the company's financial position. You can write it. It gives me the company's financial position, means how much assets, liabilities, equities the company has as on date. So please note it. Balance sheet is nothing but company's financial position at a point of time. At a point of time. Why do I say at a point of time? Because generally you prepare balance sheet at the end of the year. So we write balance sheet as on 31st December. But income statement or cash flow is for the whole year. So this income statement gives me what? It gives me the financial performance, in the sense profits and losses, revenues and expenses. So income statement is all about revenues and expenses, profits and loss during the year. During the year. Now remember, we have an entire reading dedicated only to balance sheet, only to income statement, and two readings only for cash flow. So even if you don't write anything, it's okay. All right. Cash flow talks about the cash inflow and outflow during the year. Okay. So three things: balance sheet, financial position at a point of time, income statement and cash flow. The income statement talks about revenue, expenses, profits and losses during the year. And cash flow statement gives me the idea of cash inflow and outflow in the business during the year. All right, everyone? Correct? Now, there are other financial statements. We will discuss that in a moment. But whose job is to prepare and publish this financial statement? Is it the job of the company or analyst? It's the job of the everyone online. It's the job of the firm, right? Or the company. So that is called financial reporting. Financial reporting means it is the job of the firm to provide the information about the company's financial position to current and potential investors. Current and potential investors, those who are planning to invest in the company, as well as those who are planning to lend to the company or give credit to the company. These are banks, financial institutions, those who are planning to deal with you. They would want to know the company's financial health. So it is the job of the firm to provide the information or provide the current position of the company or financial performance of the company to the current and potential investors. Why? So that they can decide whether to invest in the company or not, whether to give credit to the company or not. This is called financial reporting. But guys, as an analyst, my job is to study these financial statements or financial reports published by the company, because I am going to make a decision whether it is appropriate to invest or not. So reporting is the job of the company, but analysis is the job of the analyst. And analyst job is to use the information provided by the company, but also look at other information in the market available for that company, and then make up a decision. What is that decision called as economic decision? That means whether I should invest or not, whether I should give credit or not. So two things, reporting is different, guys, and analysis is different. Clear, everyone? Now, there is a step-by-step process to do analysis, but this step-by-step process we will understand at the end, not now. So we are going to understand what is a step-by-step process of financial statement analysis. Your job as a CFA chartered holder is not to prepare financial statements. No, that's the job of an accountant. That's a job of a CPA or certified public accountant or a chartered accountant. Their job is to prepare the company's financial statement. Our job is to analyze them. Our job is to study them. So don't mix financial statement analysis with financial reporting. Both are different things. All right. So what are the steps in analysis? That we will study it in a moment. Okay, everyone. Now, do you think the financial statements are prepared anyhow, or there is a process? Well, there is a process how the accounting transactions are recorded, how the statements are prepared. These process or rule are called financial reporting standards. Everyone in the class, everyone I'm sure is aware, there are two famous reporting standards globally. What are the two famous reporting standards? These reporting standards are called, everyone, yes, IFRS and US GAAP. IFRS stands for International Financial Reporting Standard, and US GAAP is US Generally Accepted Accounting Principle. There are two reporting standards. By the way, what are reporting standards? They basically are the rules or process through which you can publish the financial statements. Who makes up these rules? Guys, who makes up these rules? These rules are made by standard setting bodies. Standard setting bodies are organizations of professionals as well, and these professionals include accountants, or they are not regulators. Okay, don't mix this with regulators. These are independent bodies. They will recommend what the accounting standards should be. So they are professional organizations of accountants and auditors, and you can assume that they make the reporting standards. They will tell us what is an appropriate method of reporting. So standard setting bodies, there are two standard setting bodies. One is called International Accounting Standard Board for global, and Financial Accounting Standard Board for US. So IASB, which is International Accounting Standard Board, they have made up the reporting standard called IFRS. And FASB, which is for US, the reporting standard made by them is US GAAP. All right. Globally, IFRS is used, correct? But along with IFRS, they use another name. In the older stage, they used to use that name called International Accounting Standards, or that was the older name. As of now, you can say IFRS. In fact, every country has their own version of IFRS. For example, in India, we have IND AS, Indian Accounting Standard, which is more or less similar to IFRS. Of course, country-wise, there are some minor changes, right? But otherwise, globally, we all follow, everyone, IFRS. US follows US GAAP. So it's only US which is actually called as the outlier here, because US says, I have my own reporting standard. I'll not match up with the global standards. Of course, they have their own policies. Most of the reporting standards are now converged. So around 90% of the reporting standards are same. There is 5 to 10% difference, which we will study in the syllabus. Okay. Fortunately, now these days, most of the accountings is merged. So when I studied my CFA in 2009, at that time we had to study IFRS, US GAAP, so much so separately. Now, most of the things are converged. All right. So guys, standard setting body, their job is to make the reporting standards. There are two standard setting bodies, IASB and FSB. FSB prepares US GAAP, IASB prepares IFRS. But their job is to just make the reporting standard. Who is going to make sure that the reporting standards are followed by the companies on the ground? That is the job of the police, I call, which is nothing but the regulatory authorities. Regulatory authorities are the authorities, means they have the power. They are the government agencies that have the legal authority to enforce compliance. Compliance with regards to what? With reporting to with regards to the reporting standards. So whether the companies are following the reporting standards or not, and if not, what is going to be the fine, the penalty, the punishment? That is the job of regulatory authorities, not the standard setting bodies. Standard setting bodies are like, the legislators. They make the rules, but they don't go out in the on the streets to make sure that it is followed. It is the police who does that. So standard setting bodies are regulated. They are the ones who, they are the, like the legislators, and regulatory authorities are the police here. All right. Globally, we have several regulatory authorities. The most famous for your syllabus that you all should know is SEC. We are going to deal with SEC throughout the curriculum in CFA. Okay. Securities and Exchange Commission. Global Security and Exchange Commission is only for US. Globally, you have different regulatory bodies. For example, in UK, everyone knows is FCA, Financial Conduct Authority. In India, we have something called SEBI, Securities Exchange Board of India. In UAE, okay, we have SCA, Securities and Commodities Authority. They are the one who deal with equity market, capital market, reporting of the disclosures of the company. They are the ones who deal with. Everyone with me on this? Correct? But see, each country will have their own regulatory authority. However, there is a global body under which there are more than 90% of the regulatory authorities. That's called IOSCO. IOSCO is a global body. So everyone comes under the umbrella of IOSCO. All right, everyone? Check, check, check. Everyone clear what is regulatory authority, what is standard setting body? Correct? Okay. Now, most of the regulatory authorities, they have a common objective. So do I need to remember everyone's objective? No. What is the common objective of IOSCO, which is a global body? Their number one objective is to protect the investors. And how can I protect the investors? By forcing the companies to disclose and be transparent, and making sure the markets are run fair, efficient, and transparent. Their job is to reduce the overall risk of the market. Which risk, guys? See, which risk have I mentioned here? Systematic. Do you remember something related to systematic risk? Did we study something related to that? In linear regression, yes, we studied that in linear regression. Which risk did you say? Explained. Amazing. Explain means something that we all know. GDP, inflation, all those risk, volatility, we want to tap it. We want to control it. That is the job of the regulators. They don't want the market to go out of control. That's why many times, when there is a big news in the market that is going to cause panic in the market, they come up with some measures to control the market. So that is their job, not to let investors panic or lose, unnecessary money. So they are the ones who make sure that there are no scams and all. That is the number one objective of the regulators. Now, how do they do so? Well, they force companies to do a lot of disclosures. Companies have to compulsorily come up with the disclosures. They have to regularly report things. Now, those disclosures are called SEC filings. What are those disclosures called as? SEC filings, which all the US companies have to do so. And those filings are called forms. Now, there are more than 300, 400 forms. But for your exam, what are the relevant forms I've put here? You don't need to memorize it right now, but gradually I will use those terms, so you'll also get automatically memorized. For example, every company publishes their financial statements. Those statements are annual reports. These annual reports, from now we will call it as 10K report. 10K report. Same way, companies also publish quarterly reports. Those are called 10Q. 10Q. But now understand the difference. Annual reports have to be audited. Quarterly reports, they may or may not be audited. Is everyone clear with this? Number one thing, everyone check, check, check. 10K, 10Q, everyone clear? So from now, whenever I say, hey, what's the financial report? Instead of that, I will say, can we find the 10K report? 10K, 10K, 10K. So we'll use 10K word very often. All right. Remember, 10K is audited, 10Q is not. Correct? Now, whenever the company has some important event taking place, important event means not like a party, but important event where they are going to make crucial decisions. These are called material events. What do you mean by material events? Material events means some important decision that the companies have to take, like should we accept the merger and acquisition proposal? Should we go for expansion? Should we go for buying another company? Should we go for borrowing, huge amount of borrowing? Or should there be a change in the company's management? Any crucial decision which is going to affect the company's stock price, those are called material events. Any material event the company is planning to take, they have to report to the SEC under Form 8K. Why? Because many of these material events, guys, many of these material events require voting. Shareholder vote. For example, should we are planning to buy another company, so we require a shareholder vote. Should we go for this company or not? Whenever you require a shareholder vote, that is called Form DEF 14A. That is called proxy statement. Proxy statement means going for voting. Why do we call proxy? Because suppose, let's say you have 100 shares, that means you have 100 votes. Now, if you are not going to vote on that day, you can relinquish your vote to someone else. You can transfer your vote, or you can tell someone else to vote on your behalf. That is called proxy statement. That is called Form DEF 14A. So whenever there is going to be voting required, companies have to file DEF 14A. Now, whenever they file DEF 14A, that's where I get to know, oh, company is going to come up with some big event. But not all events require voting. So some of the events which are crucial but doesn't require voting, all important events, 8K. All right. Everyone in the class, check, check, check. Now, companies generally require capital. So what are the options? They go for IPO. IPO means public offering. So anyone can buy the shares. Or they go for private placement, means they issue the shares only to selected group of companies or selected group of lenders, or you can say selected group of investors. That is called private placement. Now, whenever companies go for issuing new shares, they have to file up a form called S1 before issuing the shares. So this is prior to the issue of shares. So whenever the company is planning to go public, public means IPO, they will have to file which form? S1. So for example, let's say there is a new company, let's say BYD is planning to list in US. So BYD will want to issue shares in US. So BYD first need to go to the SEC and file S1. That it's like a proposal that, hey, we want to go for issuing the shares. Do we fit the criteria? That's called S1. But if you want to issue the shares not to public, but to some qualified buyers, private institutions only, then you don't need to file S1, you need to file Form 144. So basically, if you notice here, S1 and 144, they are related to issuing shares either to public or to the private placements. Everyone with me? Check, check, check. Finally, does it matter if Elon Musk or Jeff Bezos themselves buy and sell the shares of their own company? It does. It's a big thing, right? Or if the CEO of JP Morgan or Citibank, when they buy and sell the shares of their own companies, that does affect the decision of other investors, right? So whenever there is a buying and selling of the shares by the company's officers or directors, they need to disclose that to the SEC. That is called Form 3, 4, and 5. So under Form 3, 4, and 5, when the company's insiders, when they buy and sell shares, they have to disclose it to the SEC. All right. There are several other forms, but of those, the ones which are essential for your exam is what I've put here. Okay. Let's see some questions if we can Do based on that, everyone. Question number 2, everyone in the class. The primary role of financial statement analysis is best described as providing information. Is that the job of financial statement analysis or reporting? That's the job of financial reporting, right? Not a evaluating company for the purpose of making economic decision, yes or no? Correct? Or using financial reports prepared by analysts to make economic decision. Which one? Everyone in the class, yes? Confirm? B. Evaluating a company for the purpose of making economic decision. Now, some people might say using financial reports prepared by analysts. Do analysts prepare the report? No, reports are prepared by the company. So the problem with C is that word, prepared by analysts. Analysts don't prepare the reports, they analyze the report. All right, everyone in the class, check, confirm. Question number 3. Everyone, guys, online, how many people are there? Everyone should answer. Don't feel shy. Those who don't answer, I will put them in a different group from now. Okay. 3. IFRS, International Financial Reporting Standard, IFRS, short form, okay, are currently developed by whom? Which is a standard setting body which prepares IFRS. Let me see. Yes, everyone. IFRS Foundation, International Accounting Standard Board, or International Organization for Securities Commission? The answer is everyone in the class. B, ISB. Why not C? C is regulatory body, IOSCO. Everyone, C is regulatory body. So C is not the answer. 4th, what is the core objective of IOSCO? IOSCO is nothing but the regulatory body. Remember what was the core objective? Eliminate systematic risk, protect users of financial statements, or ensure that markets are fair, efficient, and transparent. Which one do you think is correct, accurate? Everyone, C. Can you tell me why A is wrong? Correct. We cannot eliminate the systematic risk. We just need to reduce it. We cannot get rid of the systematic risk. Correct? Everyone? All right? Perfect. Okay. Now 1, 2, 3. Okay. This. Okay. Fine. Clear? All right. Now, let's go into the topic. What are the financial statements? Now, see, whenever you go for the interview, generally they ask you, hey, do you know what are the company's financial statements? Most of the people say balance sheet, income statement, cash flow. That's it. But there are actually 2 other financial statements, that is called statement of comprehensive income and statement of changes in owner's equity. Now, many of you all must have not heard what is statement of comprehensive income. So we will discuss when we go to the income statement, we will discuss what is statement of comprehensive income. It is actually a combination of 2 things. It is net income plus OCI. Don't ask me what is net income, what is OCI. We will discuss all of that when we go to income statement. But this is something new for most of us. When I did my CFA, even I heard it for the first time. What is statement of comprehensive income? I never knew it. I only knew balance sheet, income statement, cash flow. I didn't knew statement of comprehensive income. Changes in owner's equity, yes, I knew it at that time, because owner's equity is where we put up all the details of share capital, a preferred share, common equity, all those we put up in equity. So that I was aware, but comprehensive income I was not. So when we do income statement, we will discuss this. All right. But out of the 5 core financial statements, they are basically numbers. These are all numbers. Balance sheet, income statement, cash flow, they are all numbers. So how much is the asset? $1 million. How much is the liability? $500,000. These are numbers. However, not everything is included in the financial statement. Sometimes you need additional information related to those numbers. That is the most crucial thing as per me, which is called footnotes or financial statement notes. Now, we are going to discuss what is footnotes, what is management discussion and analysis, and audit report. These 3 are additional information that are very crucial for you to analyze the 5 core financial statements. All right. So let us step by step understand what is footnotes, what is management discussion and analysis, and then something that you are almost certainly going to see in exam, very, very important from your exam, is audit report. So we'll discuss about audit report in a moment. So what is footnotes? One word that should come into your mind whenever you see footnote is that it is disclosure. All the important information, disclosures means which accounting method am I following, what are the assumptions and estimation. Do you think entire reporting is of actual number? No. There's a lot of assumptions, estimations, judgment involved in financial reporting. Trust me, there is a more than half of the financial reporting is actually judgment or actually estimation. You know why? For example, I'll give you the example of depreciation. When you buy an asset, do you know on day one for how long will the asset survive? For example, let's say you buy an equipment. I bought a printer. Now, the company says that the printer has a guarantee of 5 years. But do you think the printer will only live for 5 years? It might be more or less, right? So at the time of when I bought the printer, I don't have an idea how long the printer will survive. So the accounting standard says that you have to estimate and accordingly depreciate. So you can estimate 5 years, I can estimate 10 years, he can estimate 3 years. So all three of us, our numbers might be different. So there is a lot of estimation and judgment involved throughout the financial reporting. So what is your estimation? Why did you use 5 years? Why did I use 7 years? Why did someone else use 3 years? All that disclosure needs to be in the footnotes. Understood, everyone? Check. Guys, this is not a choice. This is compulsory. Okay, companies have to do this. Therefore, remember one thing: footnotes are audited. But what is the other thing that I'm going to discuss? Management discussion and analysis. Management discussion and analysis, in short form, we call MD&A, that may not be audited. Why? Because footnotes is about disclosures. MD&A is management's opinion, view, commentary. About what? About what the past performance of the company was, what were the important things that happened, what were the decision makings that they did, what went wrong. It's like management's opinion. What do they think the impact of war will be on the company's financial, what was the impact of COVID or war on the company's financials last year? What was the impact of the tariff policy by US last year? All of these are management's commentary. Most of these discussions are related to inflation, off balance sheet obligation. What is off balance sheet obligation? For example, I'm filing a lawsuit where if I lose, I might pay billions of dollars of fine to the government. So those might not be reported in the financial statement right now because it hasn't occurred, but it might. All of this we need to do discussion, or the management provides their view about that in a separate report, which is called MD&A. But remember, MD&A is not everything which is perfect. This is opinion, commentary. So not everything of MD&A is audited, but footnotes is compulsory audited. MD&A may or may not be audited. All right. Some of the things may not be audited. Everyone clear with both of these things? Correct? Everyone check. All right. Now, under the footnotes, there is something that companies have to do, is that they have to do segment reporting. Now, what is segment reporting? Segment reporting, by the way, segment reporting is for those companies which have multiple lines of operations, multiple businesses, or businesses across multiple locations. Now, the most common example that I give everyone is Apple's business. Apple's business is divided into 5 major products: iPhone, iPads, MacBook, software that Apple does sell, and wearables like AirPods or chargers. Apple does make a lot of money with chargers. See, 1, 2, 3, and 4. I have 4 chargers for 4 different things. Apple can actually do a better job with it's such a high-tech company, right? It can actually have a single charger for all, but it deliberately does different charges for different thing. And most of the times they don't even give the chargers, right? They force you to buy it separately. So I have to buy for this different, this different, and maybe a new device that they might come up with a different charger for it. Why? Because they make billions of dollars just by selling chargers. Brazil said, no, I will not allow you to do this. This is, a scam. This is not right. So if you don't put charger in the phone box, I will not allow you to sell phone. This is what Brazil told. I don't know why other countries are not doing it. They're letting Apple do this. Apple, come on, we are paying you so high. You should give us everything in the box, right? So, anyways, I think Apple's days are just about to collapse because I don't see any progress in Apple in the last 5 years. I'm a fan of Apple's products and its financial performance. But if you notice after iPhone 12, it's almost the same iPhone, but a repackaging. Okay. Neither there is progress in the company's financial statements, neither is the progress in the company's devices. Okay. So I think God bless iPhone and Apple. Indonesia has enforced in countries production as well. Yes. Oh, that is a different thing. Anyways, Apple is looking to go beyond China. What was the worst news that happened in Apple in the last couple of years is not their iPhone not getting, highly developed, but China actually made Chinese employees compulsory to not have iPhone. So that's the biggest setback because Chinese revenue for Apple has been very high. So I will show you, I do that in every class report. So I will show you what is a segment report. In segment report, what do you notice is how much is Apple's revenue coming from China, how much is Apple's revenue coming from Middle East, Asia, Africa, etc. But Apple might have hundreds of companies across the planet, right? So is it going to report for each and every company separately? No. What does it say? That only if your particular business contributes, now remember the number, contributes more than 10% of the revenue, assets, or income, means profit, then you have to show separate report for those different lines of operations. And you don't have to show each and everything. You just have to show the key numbers. That is called segment reporting. This is compulsory for those companies which have 10% or more of their revenue, assets, or income coming from different products or different geography. So I will show you how exactly it looks like. Let me just show you. So we are looking, see, which report are we looking, guys? What is the report that we are looking? Come on, everyone. We are looking for which report? 10K report. 10K Apple, and who Apple publishes where? SEC. So I'll write 10K SEC. Now this is where either you can go to the Apple's website and go for SEC filings, or you can go to Edgar. Edgar is SEC's platform. You can search there as well. So either I go to Apple or SEC. In both the cases, you will get the report. I generally prefer going to the Apple because that's more, the website is more, interesting to go for. Now see here, I require which filings? Guys, 10K is annual filing. So I click on annual filings and I will get first itself the 10K report. The latest was November 1, 2024, last year. Apple actually has a September to September accounting cycle, right? That's why you see most of the iPhones are launched in September. Okay. I was initially wondering why September? Is it because it's my birthday in September? I just thought so, but no, actually Apple follows a September to September accounting cycle. So you will see the reports being published after September. Okay, so I'll just click on the PDF report. Okay, this is the 10K report of Apple Inc. California. And here is where I will look at item number 8, financial statement and supplementary data. As soon as I click on it, and that's where I get statement of operation, means income statement, the first one. Statement of comprehensive income. Remember, I told you what is comprehensive income we are going to study. Then third is your balance sheet, consolidated balance sheet. Then shareholders equity. And then you have cash flow statement, the 5 major things. And after that, you have notes to financial statements. So I'll go to one by one. So you will see your first, you have income statement. Our next topic is income statement. We will discuss that. Comprehensive income. Then you have the balance sheet of Apple, assets, liabilities, and equities, correct? Then you have the cash flow statement. We have 2 readings on cash flow statement. And after that, you have notes to financial statements. Consolidated means combined. Apple has multiple subsidiaries. So combined financial statement of Apple. This is nothing but your footnotes. In the footnotes, you're going to get a lot of disclosures of that. Which one are we interested into right now? We were discussing about segment reporting. This is what the segment reporting is. See here, everyone. iPhone, Mac, iPad, wearables and services. Where do you see Apple's growth coming? See the iPhone. iPhone sales is just dipping 205, 200 and 201. There's hardly any growth in iPhone sales. You see that? MacBook is falling so much. What is the reason of MacBook sales dropping? You know what? You'll be very surprised. First of all, not everyone uses MacBook these days. And those who use, they don't change it because nothing happens to MacBook. This is my experience. New sales is not happening because I've been using MacBook, touch wood, nothing happens to it. Okay. That can also be one of the reason. iPad sales is also dropping. Okay. Wearables is where Apple was expected to have higher revenue, but even that is dropping, right? Services is where Apple is now looking forward. That is software, iCloud, iTunes. This is where Apple is betting on. But if you see more or less the scenario doesn't look great for Apple. This is segment reporting product wise. They also have geography wise, which I will show you. Geography wise segment reporting also they do have. Okay. Where is it? Okay, you can also find it yourself. They do have some geography separated as to from which location, how much is our revenue. So this is it. America, Europe, Greater China, Japan, and rest of the Asia. I actually joke people that, why Apple writes Greater China. Actually, Greater China means China and Taiwan. Apple has substantial revenue coming from China. So they are scared to show Taiwan separately. They don't want China to get upset. So they use the word Greater China, which includes Taiwan. Of course, the US government recognizes Taiwan, but Apple says, no, I'm okay. I don't want to mess up with China. So that's why they use Taiwan. So this is segment reporting also because this is location wise. You will see majority of Apple's revenue is of course US, but US sales are dropping. European sales are not that increasing that much. Now they are betting on the rest of the Asia where their sales should pick up. But again, Apple is somewhere struggling with a lot of their, growth. Okay. That is what the problem with Apple is, even though it's putting a lot of amount in research and development. So this is what I get from the Edgar SEC report. Okay. Edgar is a link of the SEC, or you can go to the Apple's website and also find for 10K report. All right. Everyone clear with financial statement notes? Correct. You can go and analyze that much more in detail if you want so. Clear, everyone? Check. Let us see if there is any question related to footnotes or management discussion and analysis. Everyone in the class, do we have something? Okay, we will do that with audit report. Okay, no issues. Now, what is audit report? Every companies have to compulsorily publish an audit report. Okay. Number one, is audit a certification that everything is perfect? No. If that was the case, there would never be scams, isn't it? There would never be fraud, accounting frauds. So audit, just highlight the keywords. It's an independent review of the company's financial statement, independent review, and auditor's job is to just provide an opinion whether the financial statements are true and fair and accurate. Okay, they just have to provide an opinion. They cannot certify. So do they give me assurance? No. Remember the keyword. They just provide you reasonable assurance, not assurance. All right. And as I said, it is almost certainly always asked in exam. Once the auditor verifies or goes through the company's financial statement, they give up an opinion. Conclusion is opinion. These opinions are two types. Either the opinion is unqualified or modified. Now, don't go by the name. Unqualified means everything is perfect. Unqualified, ironically, means that the statements are free from material omission and error. Omission means nothing is missed, and error means mistakes. So, unqualified is what we desire. Everyone with me? So, we desire what sort of an opinion? Unqualified means I'm not qualified to be something wrong. That is, don't go by the words. Unqualified means good, by the way. But if the auditor has some problem with the financial reports or financial statements, that is called modified opinion, because that's where under the modified opinion, they will give you three types of opinions. Qualified. Now, whenever I say qualified, highlight the keyword. That means there are some exceptions to the accounting principles. Means the accounting principles are not followed 100% accurately. There is some exception there. But it's still not considered as a scam. The exact case of scam is when they give adverse opinion. Adverse opinion means the statements are unfairly done. They are not presented fairly or are materially non-conforming with the accounting standard. Means they are not in compliance with the accounting standards. Materially means substantially. There is something big. Anything like this happens, it's an adverse opinion. This is a perfect sign of a scam. All right. And sometimes the auditor does not get all the complete picture or all the complete information. Then they are not able to express their opinion. When they are unable to express their opinion or conclude, that is called disclaimer of opinion. All three are called modified opinion, and that sounds an alarm to the investors. Everyone with me? Check, check, check. Now, even though the audit reports were already at place, still many scams happened and many scams are still happening. Okay. So to ensure that there is a, of course, you cannot avoid all the scams because people will find some or the other way. So it's not completely possible to get rid of it, but still some additional steps were taken in US and many other countries, especially after the Arthur Anderson scam, or so-called as the Enron scandal in US, and also after the 2007-8 financial crisis, which was actually considered as a banking scam. So after that, in US, auditors had to go an extra mile and file up something called key audit matters or critical audit matters. What is key audit matters or critical? Where the auditor has to take some responsibility, in the sense they have to do an extra job by highlighting what do they think is of significance for the investors, or where do they think there is substantial management judgment and estimation involved, because that is where there is a chance of something being manipulated. So auditors have to go an extra mile and highlight those things. Okay. They need to put up all these things. How significant transactions affected during the period, or the choices the auditor finds that are challenging or subjective, and there is a possibility that it may be misstated. So wherever the auditor has some extra information to be analyzed, that, and they need to put up a report related to that, that is called key audit matters. Key audit matter is generally not so important from your exam point of view. What is very important from your exam point of view is the different types of audit opinion. I personally feel this is always tested. Audit opinion. Everyone with me? Check, check, check. So now let's do the questions related to that, everyone. Question number 5. Accounting policies, methods, and estimates used in preparing financial statements are most likely to be found where? ABC. Correct. Which methods am I going to use and all? Estimations. Are they found in audit report? No. Management commentary? No. They are found up where? In footnotes. What is footnotes? Footnote is called notes to financial statements. Remember, they are also called footnotes. Check, check, check. Next, information about the management and director compensation is most likely found in yes, everyone. Let me see the answer. Will it be in C? Earnings release. Earnings is the profitability of the company, not how much the director and the management makes. Management and director salary is not in earnings report. Earnings report is about the company's profitability. So C is not the answer, everyone. Now either it's A or B. Where would you see the management and director compensation? Yes, A or B, A or B, everyone in the class. B. Why B? Because these are important payouts for which you might require shareholder vote. So anything which is related to shareholder vote, that goes into the proxy statement. For example, if the company's director's salary is going to be increased, all these are crucial things. So for that, there is a voting, and voting comes under proxy statement. Audit report, you won't find the compensation in all. Audit report is a general report about the company's way the financial statements are prepared. All right. Next, information about a company's objectives, strategies, and significant risks are most likely found in audit report, management commentary, or footnotes, everyone in the class. Correct. It's in management commentary because it's about what are the strategies and risks that we might face or we faced in the past. It's related to management commentary. Everyone with me? Check, check, check. Correct. Next, all three questions I've put up related to audit, and I want everyone to please answer this. What type of audit opinion is preferred when analyzing financial statements? Everyone. Check, check, check. Yes, qualified or unqualified? Unqualified, everyone. All right. Next, an auditor determines the company's financial statements are prepared in accordance with the applicable accounting standard, except with respect to inventory reporting. Means there are some exceptions. Exception comes under which case, guys? Modified. And under modified, where? Qualified. Within the modified, there are three options: qualified, adverse, and disclaimer. So this is a part of qualified, exception. Look at the word. Whenever they say there is some exception to the accounting principle, that's a qualified opinion, everyone. And next, an independent audit report is most likely to provide, look at the keyword, it's reasonable assurance of the financial statements being fairly presented. Look, it's a reasonable assurance. Reasonable. Everyone clear? Right? Okay. Now, we are covered with all of these things, right? About what is the company's reporting standard, what are we going to follow, who prepares the reporting standard, who regulates them, everything, right? Now, as a CFA, my job is to analyze the company's financial statement. So there is a step-by-step process. There's a 6-step process to do so. First, who is going to make you to do FSA? Imagine a situation. Imagine I'm working in a bank in credit. My job is to decide whether this company is eligible for borrowing or not. So my objective is to analyze the company's financial statement to analyze its eligibility for borrowing. So number one, you need to be aware what is your objective of the FSA. Let's say another guy's objective would be that they are planning to take over the company. So their objective is different. Your objective is different. My objective is I want to invest for my client. So everyone might have different objectives. So stating the objective is number one. Second is gathering the data. What do I mean by gathering the data? Means collecting the financial statements. What do we call financial statement as, guys? The 10K report. Okay. Once I gather the financial statements, I need to work on it. Work on it means I need to process the information. This is where I will calculate ratios. I will make a comparison of this year with last year. All this ratio analysis we are going to see later on. We are going to compare. We are going to see the percentage growth in the revenue, profitability year on year. All of this is called processing the data. Remember, in processing, the most important thing is calculating the ratios. Once I have the ratios or I have the graphs comparison, then my job starts of analyzing and deriving a conclusion. Without conclusion, no point of analysis. Analysis is complete only when you make conclusion. So you will study the data, you will make a conclusion whether this company is worth giving the credit or not. That's your step number 4. After this, you need to know the art of making the research report. Your research report should not be hundreds of pages that no one reads it, and by the time you read it, the company is already finished one more year. So no, your report needs to be simple in a language that is appropriate for the audience. Okay. Now, since most of us have done quants, what if my report is filled up with variance, target semi-standard deviation and all those? And imagine you never did CFA. Would you understand most of the report? No, you wouldn't understand. So the report has to be in a language that the audience can connect it. So that is called reporting the conclusions or recommendation. How you report it. It needs to have a conclusion whether to buy, sell or not buy. And finally, it needs to be communicated to the users. But remember, this is not a one-time job. Every quarter, the companies come up with new performance. So you have to update for your clients and for yourself regularly. Your analysis cannot be constant. Today, I recommended a stock. It won't be a recommendation forever. Maybe after a quarter, I might change my recommendation. So I'll have to keep on constantly updating. All right. Now, what if clients generally, when I was in the research, I recommended a stock to the client, and I was in the IPO research. So we recommended it. After a year, I said, sir, this company doesn't look promising anymore. So exit. So he said, why should I exit a company? You recommended me. I said, yes, but sir, at that time, the situation was different. Now the situation is different. He said, how can you change your recommendation? So then I used to make I used to read a lot at that time. These days, reading is less, scrolling is more. So at that time, I used to read a lot. So I said, sir, do you know Winston Churchill, the British Prime Minister during the war? He was of the opinion, no war, no war, no war. Finally decided to do war with Germany. So then everyone accused him, why are you going for war when you said? So then he used a famous dialogue, which I tell to my clients. Those who don't change their mind, change nothing. So sometimes you need to change your mind. You need to adapt. You need to change to the situation. All right. So same way, sir, I recommended you the stock at that time. It was fine. Now I don't recommend. 3 months back, I told everyone that Tesla is overvalued, overvalued, overvalued. Today, after all this incident, I think now the correction has happened. Now it's a good point to invest. Now, this is just an example, okay? Don't buy Tesla and tell that sir told me to buy. I bought it. This happened. Disclaimer, I'm not saying to buy. I'm just giving an example, okay? So that is what you need to update the analysis, all right? Just to give you an option that if the Tesla shares have fallen by, I think 20-24% they have fallen, right? Correct? Maybe something like this. So if they have fallen by 20-24%, suddenly you see the news, oh, there's going to be no fight more between Trump and Elon Musk. Someone is going to mediate. They will become friends again. Tesla stocks will go up. Now, this is stupidity. A stock going up or down just on the basis of the mood swings of the people. That sounds very funny. Okay, these are the steps. Now, under these steps, look at step number 2. Gather the data. Gather the data means you are going to collect financial reports. But tell me one thing, are you only going to depend on the company's financial reports, or you will look at other information in the market also? You will look at other information in the market also. That other information, please go to the last page. These are the informations used by analysts. So company's information actually comes from 4 sources. One is the issuer source. What do you mean by issuer source? These are the information released by the company itself, like the earnings call, presentations that the companies do, press conferences. All of these are issued by the company, issuer sources. Everyone with me? Correct? Then there are third parties who provide information on the companies. These third parties are either public or proprietary. Proprietary means paid. Public means they are available for everyone. Public third party are free industry reports or trade journals. Government agencies also publish report. Many people go to Reddit. Remember GameStop? Everyone bought GameStop just on the basis of Reddit discussion. So social media, all these are public, open, third party resources. Proprietary are paid. These are analyst reports. Whenever you go to Bloomberg, Reuters, have you used Bloomberg terminal? Many of the management institutes, they have Bloomberg terminal. Almost all the finance companies or investment companies, they have Bloomberg terminal where you can go on Bloomberg and get any report or any data. Those are paid, by the way. They are not free. They are called proprietary third party. Like Bloomberg, you have Reuters also. Okay. There are many, Captiva and so many. S&P also provides. Yes, yes. Anyone uses? Bloomberg is very expensive. Yes, because this is for billions of dollars. It's expensive for you and me, but not expensive for Adia, Mubadala, BlackRock, Citibank. Not expensive for them. Okay, expensive for us. That's why we don't have Bloomberg at homes. We go to the office and use Bloomberg. But whenever you want to go and use Bloomberg in your office, there's always someone there, isn't it? So that's all those who are in the trading and research. They have the Bloomberg terminals for sure. All right. These are proprietary third party. But sometimes there are research reports commissioned by some analyst or by the company itself. The company itself would want to do a due diligence of my company. So they are the reports commissioned by the authority, commissioned by the bank, commissioned by another companies. These are proprietary primary research. They include data and advice of technical specialists. So these are specialist reports. Okay. They are conducted by some specific organizations. They are called proprietary primary research. Okay, everyone. So these are additional sources apart from the 10K report that I will look for whenever I want to analyze the company. All right. Yes. Now we can do question number 1. Everyone in the class? Very important. Ratios are input into which step in the FSA, into which step of financial statement analysis framework? Processing the data or analyzing and interpreting the process data, collect the input data. Guys, I have A, B, and C. Everyone. Processing, yes, everyone. Check, confirm. Everyone is confirmed with A. Where do we do ratios? See, check here. Ratios is what we calculate in processing the data. Understood? This is where do we calculate ratios in processing? Is it an input there? Input. What is the next step? Analyze and interpret the data. Guys, I want everyone to take a step back and tell me whether it is A, B, or C. Take your time. I will also show you something related to this in a moment. Just let me show you. Wait a moment. I'll also show you the notes. Okay. See, your first one. Remember, everyone, ratios are, the answer is not A, not B, it is C. Why it is C? Because the word input, ratios are in the processing, it's an output, it's a final thing that you utilize and then do the analysis. So almost everyone thinks the answer is just they see ratios and they all say the answer is, hey, the answer is sir A. But don't miss out the part that in processing the data, ratio is the outcome. It is the output, not the input. Understood? You use that ratio as an input and then analyze and give your conclusion. That is C. So it's not A, it is C. C. Everyone check. Understood why C and why not A? Are you still in the shock? Everyone, it's not A. In A, processing the data, it's the output. The final outcome is ratio. The next step is analyzing the data, interpreting the data. That's where I require ratios as an input, and then I will do the analysis. So read it carefully, everyone. Understood? Check. Everyone realized? I'll repeat again. See, you need to just not read one word and conclude, okay? See, what is it? Okay. Again, gathering the data, you collect the data. Step number 3, processing the data. This is where you are going to use the financial statement and calculate the ratio. So ratio is not going to be your input. It is going to be your output, your final outcome. Okay, in step number 3. In step number 4, you will use this ratio to make your conclusion or you to make your decision. So in step number 4, I use ratio as an input. Understood? So those who said A, actually they just saw, oh, ratios, finished, A. No. See, this is where this is the difference between CFA and other topics. You need to carefully read. It's an input into which step? Analyzing. It's an output in process. Understood, everyone? Check, 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 check. Clear? All right. Yes. This is the end of your first topic, even though very short topic, but very important. Now, the next 4 readings, which are income statement, balance sheet, and 2 readings of cash flow. I'll just tell you one thing. Those who do not attend these 4 readings carefully, or those who skip this, they will certainly have an issue throughout FSA and the whole of CFA. So the next 3 readings, balance sheet, income statement, cash flow, whatever is exam oriented, I'll discuss, but don't try to miss it. And when you finish balance sheet, income statement, and cash flow, that's where you need to go to the FSA and do the revision on the spot. Okay, so now whatever I cover in the class, you can go back and do the CFA questions, whichever you want. Okay. All right. Perfect. Everyone clear with the first topic? Check, check, check. Very easy. Just a 2-page topic, 3-page topic, but just gives you a brief summary of what is going to come up. All right. Now, the major thing is going to be income statement, balance sheet, and cash flow. All right. Yes.